So we'll continue through the balance sheet. At this point, we're on the intangibles. And intangibles are a very interesting list of assets. Intangibles are basically long-lived assets, meaning used more than a year, that have no physical substance, but they have a value. So some really good examples are copyrights, trademarks, customer lists, licenses, technology, franchises, and something called goodwill. And if you think about it, that makes sense. I mean, the value of the Nike Swoop trademark is very important to them. You know, the Disney World logos they have, or the NFL and all the copyrights and trademarks they have, those are all very valuable, and they know it. So they don't have a physical substance. It's a thought or an idea that they have, but at the same time, those non-physical substance items are very, very valuable. If they have more than a year, you know, if they're going to be used up over more than a year, then we do have to allocate them, right? So if they're not, you know, infinite in time, you know, for their value, if the value will always be with us, in other words, then we will have to allocate the cost, and we call that amortization. Think of it like depreciation. Amortization is just taking, you know, for example, one of the ones I didn't list up here was possibly a patent. Maybe the patent they expect it to be good for 10 years. And so you're going to split up that cost over 10 years. You're going to spread it out over the useful life of that patent. It's very much like depreciation. Amortization is just used for that as the terminology for spreading out the intangible cost over its useful life. Again, when you look at the value of the intangibles, you want to keep in mind that, you know, that there's some flexibility there for management. Again, so that needs to be kept in mind when you're considering the valuation they put on that asset. Another thing is I want to mention goodwill, because goodwill sounds like charity, but it is not charity. Goodwill is when you buy an entire business and you pay more for it than the assets. So let's say, for example, you buy a limousine service. So you buy, you know, maybe half dozen limousines, and the value of the limousines, Blue Book, is, you know, $100,000, but you pay $500,000 because it's such a good business, it's well run, it's got a lot of name recognition. That extra something you pay on top of the value of the assets, that's called goodwill, and you only see it when you buy the entire business. If you're buying a piece of the business, that'll be handled a little differently. But that's what that means when you see goodwill on a balance sheet. Okay, let's move on down and look at the next part. So our total assets came to $25,000. We're going to look at the liabilities. So liabilities would be our obligations. This is what we owe, something we owe. Now it's current because we have to pay. We have to satisfy that obligation within 1 year, right? 1 year. So that's how we know it's a current liability versus a long-term liability. Accounts payable. So let's look at that one. So let's add a sticky note for accounts payable. So accounts payable is something we owe. So maybe we ordered some office supplies, and they send us the office supplies, and then they send us an invoice, and we haven't paid the invoice yet. So that is, you know, an account payable because it's something that we owe to another business. It's slightly different from what they call a note payable. You'll see notes payable sometimes, but a note payable is more of a formal loan. And if the loan is for less than a year, then it's a current liability. If it's for more than a year, then it's a long-term liability. An account payable is more something you do in your day-to-day operations. So if we're always ordering, you know, office supplies from Taylor Office Supplies, then that constant cycle of business over and over again with Taylor Office Supply, we're going to have an ongoing relationship with them, and we call that an account payable. A note payable is more like a one-time one-time situation where we maybe need a short-term loan to do something with the bank, and so we actually have more of a structured loan set up. That's kind of the difference between an account payable and a note payable. Now there's other things that we owe, right? For example, let's say some employees worked for us, but we haven't paid them yet because pay day hasn't happened yet. We would call that accrued wages. So that's wages we owe to our employees for working for us. Now, if we paid the employee, if we actually paid them, then that would be an expense. So these expenses are when we actually pay the employee. However, when they worked for us but we haven't yet gotten to payday yet, that would be considered like accrued wages or wages payable. Now we also owe Uncle Sam or the government, right, for taxes. So that's another example of a payable, and it's short term because you usually have to pay your taxes within a year, right? And then we have a very important one, right? It's called unearned revenue. Now, anything that says revenue, you would think goes on the income statement, and you'd be right except for this one exception. So unearned revenue is a situation where we've been paid in advance. So let's say somebody paid us for some parts, maybe some truck covers. They paid us for some truck covers, and we haven't shipped them yet. So we haven't done our part yet. We haven't earned our revenue yet. So we have a liability. We can't keep that money. We have to send them the truck covers. That obligation, that liability, is called unearned revenue. You see it with airplanes, right? With the airline industry. So you pay for your flight to go to Denver or wherever, and you paid for it, but they haven't flown you, so they have unearned revenue. Tickets, you buy a concert ticket or sporting event ticket, but they haven't performed yet, so we have unearned revenue for that, for that team or that, the symphony or the band. They all have unearned revenue until they actually perform and do their part. So that unearned revenue is a liability, so make sure that you are clear on that. All right, let's clear these out and look at the long-term liabilities. One long-term liability we might see is a mortgage payable. So a mortgage is usually a long-term loan, like maybe 30 years that you take out on a piece of property. That's obviously long-term. And then a bond. So a bond is a loan that we've made with other creditors. So if I were to, for example, buy a bond from, let's say, a company like Tesla, I buy a Tesla bond. Tesla owes me money. I basically lent Tesla money. So I bought a $5,000 bond from Tesla. I owe Tesla. Tesla owes me $5,000 back plus interest. That's what a bond is. It's a way for a business to take out loans other than with the bank. It's just another way for them to do it on the market. So this company, Monster, they have some bonds. So they owe this $2,000, and along the way they're actually going to pay interest on that.